let's say I get a 30-year fixed mortgage right now. All right. I buy a property, but now inflation actually goes back down to 2%.
Good
Now
question.
I'm paying,
Yeah.
now I'm paying 4%.
Yeah. Well, the likelihood is, with history as our guide, if inflation goes down that much, rates will also go down a whole bunch. Because when inflation cools, there is no longer a reason to have high rates. The reason to have high interest rates is to cool inflation. So those two are correlating indicators, right? The reason we have high rates now, and historically they're not even that high, but we think they're high because we came off an extreme low. They feel high, right? But they're really not that high, historically speaking, is because the Fed is trying to increase unemployment and cool the economy. They're doing it. It is happening.
Sure. But if I get a 30-year fixed of 6%, and then the inflation goes down, the interest rate might go down as well, but I'm stuck with the 6%.
Well, no, you're not. You're going to
So
refinance.
I'm going to refinance. That's right.
Yeah. Yeah, of course.
That's right.
I mean, look, one of the things I love about income property, I always say income property is the most historically proven asset class in the entire world. Think of it this way. We've all entered into agreements with people and companies over the years. And sometimes the other party breaks the agreement. And we call them a lot of bad names, to keep it kind of clean. I'll just call them weasels. Okay. These are people you don't want to deal with, people that don't keep their word. They're bad people, right? You don't want to do business with them because they break their agreements. But with income property, the beauty is we get to constantly renegotiate our agreement. Okay. When we buy the property, we agree to one deal, but that's not the forever deal. With stocks, with precious metals, with cryptocurrency, that is the forever deal when you buy it, because you have locked in what the deal is. Okay. You've locked in a price, and the only way you're going to make money is to sell at a higher price with those assets I mentioned. Okay. Stocks, one little caveat is you might have a dividend paying stock. You might make a little bit of money off dividends, but it's not going to be much. Okay. With income property, though, it's a multidimensional asset class, and it's a renegotiable asset class. So we can agree to one deal. Then later, when circumstances change, we can just make a new deal. We can refinance the property. We can improve the property. We can decide to rent it out on a different structure. For example, we might buy it as a long-term rental and convert it to a short-term rental, or we might convert it to a lease option or rent-to-own deal and increase our income that way. We might decide, hey, we should really remodel the kitchen. We could do it cheaply, and it would really increase the income quite a bit, or the value quite a bit, right? We can refinance and change the mortgage and change the debt stack underneath the property, right? So we can always renegotiate a lot of things. Another beautiful thing about that is that income property is one of the very few assets where we can acquire the asset and then later, sometimes very shortly thereafter even, get all of our money back out of the asset, but still own the asset. That's incredible. If you think about, that really is an incredible thing. You can't do that with many other things. So it has special multi-dimensional characteristics, and that's why it's such a proven asset class.
Can you explain that a little bit more, like how that works with like getting your cash back out?
Yeah, sure. It's just a simple cash out refinance. So we buy the property at one price, we get certain terms on that mortgage, and then we refinance the property later and we pull our cash back out of it, but we still own it.
Mm-hmm. For that to work, like does the value of the asset have to go up?
Well, the value has to go up if we want to keep the same loan to value ratio. So if we put 20% down and we finance 80% of it on the purchase, then it needs to go up in value by at least 20% in order to make that deal work, right? But, we might have put more down on the purchase, or, it all depends, right, on how we structured the financing when we bought it. But simplistically, yes, it would have to go up in value if we want the same loan to value ratio in the future.
Yeah. I've noticed since I was very, very young that investing in a house was a good idea. Just looking at, my parents buying a house and then 10 years later looking at how much it was worth. I was like, wow, this is, this, when I was little, I was thinking sounds like getting rich while you sleep almost, right? So I've always been a big believer in investing in real estate. And I've owned real estate for 15 years now. But, I think there's a lot of, like, because the interest rates have gone up so much now, I think a lot of people are hesitant to get into the real estate market, right? To actually purchase. And it's also, with the current interest rate, you need to put, like, the mortgage is going to be a higher percentage of your income than it was, like, a couple of years ago, right? So is that going to push prices down, you think, or not?
Well, you're talking about for buyers in the general market?
Yeah.
Or are you talking about yourself?
No, just the general market.
The general market.
Just
Okay, good.
general US markets.
Yeah, this is a great time to look at a couple of charts because I got some really good data for you here. And I'll explain the chart. Okay, so what this chart is basically a chart of the existing mortgages held by tens of millions of homeowners in the United States. Okay, and what it shows us here is that about 25% of all mortgages in the country are below 3%. Below 3%. 285,000 mortgages in the country are below 2%. 4.7 million mortgages are below 2.5%. And 13.1 million are between 2.5% and 3%. This is incredible. This has never happened before. This is a first-time thing. Okay? Now, let's go up a little bit. Let's take another percentage point. 65% of all mortgages in the country are below 4% interest. Think about it. If the official inflation rate is 8%, if these people live in the houses and use them as their own personal residence and don't produce any income from the property, they are not only getting a free place to live, but they're also getting paid 4% every year to borrow the money based only on the official rate of inflation if they're one of the 65% that have a mortgage below 4%, not the people that are doing even better below 3%, but just below 4, okay? They are creating an incredible amount of wealth for themselves.